Have you ever just watched a business, maybe your favorite coffee shop, and thought, wow, they just flow. Everything seems so efficient.
Yeah, like a well-oiled machine. They get things done, resources seem perfectly used.
Exactly. Well, today, we're kind of pulling back the curtain on how companies manage that and maybe more importantly, how we can measure it. Welcome to the deep dive. Our mission today is digging into something called activity ratios. Now, these aren't just, dry numbers on a page.
Not at all. They're actually really powerful tools. They show how efficiently and effectively a company is using its assets.
Right, using assets to generate sales, manage the day-to-day stuff.
Mm-hmm.
And this deep dive, it's really meant to be a shortcut for you, the listener, to get a handle on these key financial insights. We want to equip you with the core ideas, how to actually calculate them, and maybe most critically, the why it matters angle.
Yeah, looking at it from different viewpoints.
Exactly. Like, what does an investor look for? Or an analyst trying to figure out performance? And especially, how auditors use these things to spot potential warning signs.
Those red flags are crucial for auditors.
Definitely. And speaking of solid grounding, we should mention where today's material comes from. Before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com.
That's right.
So whether you're an accounting student, maybe studying for the CPA exam, or even a working professional, you should check out the website. They've got extra practice questions, video lectures, lots of support for today's topic.
It's a great resource. So special thanks to Professor Farhat for providing this valuable material.
Absolutely. Okay, so with that setup, let's really unpack this.
Mm-hmm.
What are activity ratios fundamentally?
Yeah.
And why should someone interested in business really care?
Well, I like to think of them as kind of like a company's financial heartbeat. They show how well it's turning its resources, its assets, into actual results, like sales.
Okay, a financial heartbeat. I like it.
Yeah, at their core, they measure how effectively assets are being used. Think about, say, a factory. How fast do raw materials become finished goods?
And then how quickly do those goods get sold?
Exactly. And how fast do you collect the cash? These ratios basically measure that operational speed.
And why they matter kind of depends on who's asking. Right.
Absolutely. If you're an investor, before you put your money in, you need to know if the company uses its assets well. Are they making their investments work hard?
Makes sense.
For an analyst, it's about getting insights into operational performance, building that whole picture of the company's health. Is it sustainable?
And you mentioned auditors before, the warning signs. How do these ratios help them pinpoint issues?
Yeah, that's a really key use case. An auditor uses these ratios like a diagnostic tool. If a ratio looks, well, out of whack maybe, or it doesn't line up with what they expect.
Compared to last year or the industry.
Right, exactly. Compared to prior periods or industry benchmarks. That signals an area they need to investigate further. It helps them focus their efforts efficiently, find where the potential risks might be hiding.
Gotcha. It helps them know where to dig deeper. Okay, let's get specific then. Let's talk about collecting money. When a company sells on credit, they need to get that cash back. How do we measure how good they are at that?
That leads us straight to accounts receivable turnover. This ratio tells you exactly that, how quickly a company collects the money from its credit sales.
Okay, and how's it calculated?
Pretty straightforward. It's net sales, that's your total sales minus returns and allowances, divided by your average account receivable.
Okay, net sales over average account receivable. Now, I remember reading that using the average there is pretty important. Why not just use the balance at the end of the year?
Oh, that's absolutely critical. Think about it. Net sales comes from the income statement, right? That covers a period of time, like a whole year.
Right.
But accounts receivable, that's on the balance sheet. It's a snapshot at a single point in time, say December 31st.
Okay. Period versus point in time.
Exactly. So to compare them fairly, you need to average the beginning and ending receivables for the period. That gives you a denominator that actually matches the time frame of the numerator, the sales, makes the ratio much more meaningful.
Okay, that makes sense. So let's say we do the math. Net sales, maybe 2.25 million divided by the average receivables, and we get, say, 5.28. What does that number, 5.28, actually tell me?
It tells you the company essentially sells on credit and then collects those receivables 5.28 times during the year. They cycle through that money owed by customers just over 5 times a year.
So higher is generally better here.
Generally, yes. A higher turnover means they're collecting cash faster, which is great for liquidity. It can signal good credit policies, strong customer payments.
But could it be too high?
Potentially. Very, very high turnover might mean your credit terms are super strict. Maybe you're turning away decent customers who just need a bit more time. But usually, faster is better.
Okay, 5.28 times a year.
Mm-hmm.
It still feels a bit abstract. Can we think about it in, like, days? How many days does it take them?
Yes, definitely. That's where the days to collect comes in, sometimes called the average collection period. It's much more intuitive.
How do we get that?
Simple. You just take 365 days in the year and divide it by that account's receivable turnover figure. So 365 divided by 5.28.
Comes out to roughly 70 days.
Around 70 days, yeah. So what that means is, on average, after this company makes a sale on credit, it takes them about 70 days to actually get the cash in hand.
70 days. So they sell, wait 2+ months, collect, repeat. What's a good number here? Is 70 days okay, or should it be lower?
Ideally, lower is better for most businesses. Many companies aim for 30 days or less, especially if their payment terms are, say, net 30. Faster collection means cash is free sooner for other things, paying bills, reinvesting. Now, from an auditor's view, if this 70 days suddenly jumps to 90 next year or drops to 50,
That's a red flag.
big red flag. It suggests something's changed significantly with sales recording or how receivables are being managed or collected. You'd want to know why. Consistency, even if it's 70 days year after year, suggests predictability.
Okay, that really clarifies the receivable side. Now let's shift from money owed to the company to the actual stuff they sell inventory. How do we measure how well they handle that? My garage could definitely use some improvement there.
Uh-huh. You and me both.
Yeah.
That's exactly what inventory turnover measures. It shows how efficiently a company's managing its stock, selling it and replacing it.
And the calculation, similar idea.
Similar logic. It's cost of goods sold, what the inventory actually costs them, divided by average inventory.
And again, average inventory for the same reason. COGS is over a period.
Precisely. COGS is from the income statement covering the period, so you need the average inventory balance over that same period for a good comparison.
Okay, so let's say we run that calculation, COGS over average inventory, and we get 4.15. What's the story there?
That 4.15 means the company effectively buys its entire inventory, sells it all, and then replaces it 4.15 times per year.
And like receivables, higher is usually better. You want stuff moving.
Absolutely. High inventory turnover is generally a good sign. You don't want products sitting on shelves getting old, obsolete, or costing you storage space.
Right. Avoids obsolescence and carrying costs.
Exactly. It suggests good supply chain management, accurate demand forecasting. You're buying what you need and selling it quickly.
Makes sense. Can we turn this one into days, too? Like, how many days does stuff sit there?
Or we can. That gives us days sales and inventory. You just divide 365 days by the inventory turnover.
So 365 divided by our 4.15 turnover.
Comes out to about 88 days.
88 days. So on average, an item sits in their inventory for almost 3 months before it's sold.
That's what it implies, yes.
And for this, lower is almost always better, right? I've heard stories about Apple being amazing at this.
Oh, Apple is legendary. Historically, they've had periods where their days sales in inventory was down around 7 to 10 days.
Just over a week.
Yeah, imagine the efficiency. Basically, everything you see gets sold and replaced that quickly. It's incredible supply chain management.
That's impressive. Now, thinking like an auditor again, what if you expected that 4.15 turnover, but the calculation comes out way higher, like 6.38?
Okay, that's another potential red flag. If sales haven't dramatically increased to explain that jump, a much higher turnover could, counterintuitively, suggest that inventory might be understated on the balance sheet.
Because a smaller denominator, inventory would make the ratio bigger.
Exactly. If the average inventory number used in the calculation is too low, the turnover ratio shoots up. So an auditor sees that unexpected spike and thinks, maybe they didn't count all their inventory or valued it too low. It definitely warrants investigation.
Interesting. Okay, so we've covered money coming in from customers, receivables, and managing our own stock inventory. What about the other side, paying the bills? Paying our suppliers?
Good question. That brings us to accounts payable turnover. This one measures how quickly a company pays off its own bills to suppliers and creditors.
And the calculation follows the pattern.
It does. It's cost of goods sold divided by average accounts payable.
COGS over average payables.
Okay.
So if that number comes out to, say, 7.7,
That means the company is basically paying off its entire accounts payable balance 7.7 times per year.
Can we turn that into days, too?
Yep, days to pay, 365 divided by 7.7 gives you about 47 days. So on average, they take 47 days to pay their suppliers after an invoice is incurred.
Okay, 47 days. Now, for receivables and inventory, faster was generally better. Is it the same here? Do you want to pay your suppliers really fast?
This is where it gets nuanced. Unlike the others, good here really depends on context.
How so?
Well, paying very quickly might keep suppliers happy, sure, but it also uses up your cash faster. Maybe the industry norm is 60 days. Maybe the company has negotiated longer terms with suppliers specifically to hold on to cash longer and improve its own cash flow.
So paying in 47 days might be fine, or it might actually be faster than necessary, using up cash they could hold on to longer.
Exactly. It's less about universally high or low being good, and more about understanding what's typical for the industry and what the company's strategy is regarding its working capital and supplier relationships. Maybe stretching payments to 60 days is actually optimal for them.
Got it. Context is key for payables. Okay, this is great. We're looking at these individual pieces, receivables, inventory, payables, but it feels like they must all connect, right? Like parts of a bigger cycle.
They absolutely do. And bringing them together gives us some really powerful insights into the company's overall operational flow. We can look at the operating cycle.
The operating cycle, what does that encompass?
It's the total time elapsed from the moment a company acquires inventory until it finally collects the cash from the sale of that inventory.
Okay, so from buying the stuff to getting paid for selling the stuff. How do we calculate that?
It's simply the days sales and inventory plus the days to collect accounts receivable.
Okay. So using our examples from before.
Yeah.
88 days for inventory to sell, plus 69 days to collect the cash.
Add them up. 88 plus 69, that's 157 days, roughly.
So 157 days, that's the time from getting inventory in the door to getting cash back for it.
Correct. That's the full operating cycle length. But there's another cycle that often tells an even more interesting story about cash. That's the cash conversion cycle, or CCC.
Okay, cash conversion cycle, that sounds important. What's the unique insight there?
The CCC tells you how long the company's cash is actually tied up in its operations. Think of it as the time lag between paying for inventory and collecting cash from customers.
So it factors in when we pay our bills too.
Precisely. The calculation is the operating cycle minus the days to pay accounts payable.
Okay, so our operating cycle was 157 days, and our days to pay suppliers was 47 days. So 157 minus 47.
Gives you 110 days. That's the cash conversion cycle.
110 days. What does that mean in practical terms? Can we walk through the timeline?
Yeah, let's visualize it. It really helps. Day 0, you buy inventory. Okay.
Got it. Day 0, buy inventory.
Now, based on our days to pay, you don't actually pay your supplier for that inventory until day 47.
Okay, so cash goes out on day 47.
Right. But remember, the inventory doesn't sell until day 88, our days in inventory. So that inventory sat there for 41 days after you paid for it.
Okay. Paid day 47, sold day 88, 41 days in between.
Exactly. Then after you sell it on day 88, you still have to wait for the customer to pay you, which takes, on average, 69 days. Our days to collect.
So 88 plus 69, that takes us to day 157. That's when the cash finally comes back in from the sale.
Correct. Now, the cash conversion cycle, that 110 days, where does it fit?
Is it the gap between paying our supplier and getting paid by our customer? Between day 47 and day 157?
You nailed it. It's the time cash is out the door. Day 47, paid supplier, to day 157, collected from customer. That's 110 days. Or think of it as the 41 days the inventory sat there after being paid for, plus the 69 days waiting for the customer cash.
110 days your cash is tied up, unavailable. Wow.
It's a really critical number. The goal for most companies is to make that CCC as short as possible.
Why short?
A shorter cycle means you need less working capital tied up just to keep operations running. Your cash cycles back faster, allowing you to reinvest it, fund growth, or just operate more efficiently.
So ideally, you want to collect from customers quickly.
Yes, shrink those receivable days.
Sell inventory fast.
Yes, shrink those inventory days.
Yeah, and pay your supplier slower.
Well, within reason and based on your agreements, yes. Stretching out your payables, increasing those days to pay, actually reduces your cash conversion cycle.
That feels a bit counterintuitive, but I see it in the formula. Okay, so who's really good at this?
Think about the giants like Walmart. They have immense bargaining power with suppliers.
Right.
They often negotiate very long payment terms. Combine that with their incredibly efficient inventory management and fast sales, They can sometimes collect cash from customers before they even have to pay their suppliers for those goods.
Wait, so they collect cash before they pay. Their CCC could be negative.
Exactly. A negative CCC is like the holy grail of working capital management. It means your suppliers are effectively financing your inventory and operations. It's an incredibly powerful position to be in.
That really drives home how these interconnected ratios paint a picture of a company's business model and power.
Sure.
Okay, one last one. Is there a big picture ratio for overall asset use?
Yes, there is. That's the total asset turnover. It gives you a broad view of how efficiently the company is using all of its assets, not just receivables or inventory, but everything, plant, equipment, etc., to generate sales.
How's that calculated?
Simple again. Net sales divided by average total assets. Remember, assets are from the balance sheet, so we use the average again.
Net sales over average total assets.
Okay.
And if that comes out to, say, 0.76,
That means for every dollar of assets the company owns, it's generating 76 cents in sales during the year.
is 0.76 good or bad?
Again, it depends heavily on the industry. A grocery store might have a very high asset turnover because they sell high volume on relatively lower cost assets. A heavy manufacturing company or a utility will have massive investments in assets, so their turnover will naturally be much lower.
So like the others, context and comparison are key. And for an auditor,
For an auditor, you have expectations based on the industry and the company's history. If that 0.76 suddenly drops to 0.50 or jumps to 1.0, you need to know why. Is it because sales changed dramatically? Or did the asset base change significantly? Maybe they sold off a big factory or acquired one. It points you towards areas needing investigation regarding how effectively assets are being deployed or if assets are recorded correctly.
okay, that ties it all together nicely. So stepping back, we've gone through quite a few ratios. Accounts receivable turnover, inventory turnover, accounts payable turnover.
Then connected them with the operating cycle and that really insightful cash conversion cycle.
And finished with the big picture, total asset turnover. What's the main takeaway for someone trying to understand a business better?
I think the bottom line is that these activity ratios, taken together, give you really critical insights into how well a company is actually running its operational efficiency.
It's not just about profit margins, but how effectively they manage the flow.
Exactly. How quickly do they turn inventory into sales? How fast do they get paid? How well do they manage paying their own bills? And how effectively are all their assets working to generate revenue? It paints a much more dynamic picture of the business.
And for you, the listener, getting comfortable with these ratios really gives you a more sophisticated lens to view any business.
Yeah, whether you're thinking about investing or analyzing a competitor or even just curious about how a company operates, these numbers tell a crucial part of the story.
They move you beyond just the surface level.
Hmm.
Okay, as we wrap up this deep dive, here's something to think about. That cash conversion cycle idea. How might that apply outside of big companies? What about in your own life?
Interesting thought.
Think about your personal finances, or maybe a project you're working on, even a side hustle. How long is your cash or maybe your effort and time tied up before you see a return or achieve the goal?
Yeah. When do you pay the effort and when do you collect the reward?
Exactly. Could you make small tweaks to shorten your cycle, free up your time, your energy, your money faster? It's a really interesting way to think about efficiency, no matter the scale.